Good evening, or good afternoon I should say. The time is 12 p.m. Australian Eastern Standard Time, and the day's date is the 21st of December 2012, and you're listening to Angus Geddes. A very warm welcome to all of you joining me today. Now, this is the last audio for this year. The next audio will be on the Friday for the week beginning the 7th of January, as the office shuts down over the Christmas period. I think this year's been a challenging year, and it's been a rewarding year, but it's certainly been challenging. And we're sort of running into the 31st of December. I think the markets are pretty much playing out as we anticipated. We're getting the strength coming through in equities in Asia, Europe, and also the United States, as we get more certainty that there is going to be a light at the end of the tunnel with respect to the fiscal cliff and the politicians being able to reach some form of compromise. I don't have really any major doubts that the US economy is not going to get around the fiscal cliff, and I certainly don't think that life is going to shut down and the lights are going to go out in the United States on the 1st of January if Washington has not yet reached a compromise. But I do believe a compromise is coming, and this is one of the reasons that's providing an impetus, I guess, to the upside for equity markets. The other significant factor this week was the growth rate in China being revised up to 8.4%. This is significant, and I think it coincides and provides an explanation and a reason for why the Shanghai Composite Index has broken out of a major downtrend, a major bear market that's been in place for 4 years and is now moving to the upside. And I think that we're going to see a lot of that underperformance from the Asian region that's occurred over the last few years begin to reverse itself in 2013. So just as 2012 was really the year that US stock markets shone, and I guess also Germany, which has pushed up to near record all-time highs, just as those markets dominated in 2012, I think it's going to be Asia's turn next year. It's clear, or it's becoming increasingly clear to markets, that China's growth rate is now accelerating. And as I said before, the World Bank has reaffirmed adjusted upwards and revised upwards its growth forecast to 8.4% for 2013. It's clear now that to the markets that the underlying growth rate is accelerating, and I think that's going to have a positive implication for the broader region, but also commodity prices, which I believe have made major lows this year and are now pushing to the upside. We've seen iron ore push above $130 a tonne. We've seen BHP and Rio, two of the largest diversified resource companies, make medium-term highs this week and move. The share prices have moved up to the highest level, since the beginning of this year. And that really is telling, I believe, for the rest of the resources sector. What is good for Asia, what is good for China, what is good for commodities is going to be good for the commodity countries such as Canada and certainly Australia. And I think that the All Ords index is not going to go below 4,500 next year. In fact, I think we have finished with that range, and it's a range that has captured the market, I guess, for the last few years. I think we've definitively broken up out of that range, and our index is going to move up towards 5,000 and beyond in the new year, and that will be powered by two drivers. One will be the resources sector, which will recover strongly next year, and secondly, we're likely to see further interest rate cuts from the RBA. It may not be as aggressive as what some economists are calling for today, but I still think there's another 25 to 50 basis points at least, with that cash rate going lower, and that will in turn drive the yield side of the stock market higher. We're likely to see the banking sector have another move to the upside. So all in all, I think we're in for an interesting year next year, and we're finishing on a reasonably strong note. The one blemish, I guess, to what we were looking for in terms of our scenario for this year has really been the gold price. It has failed to fire, and there's no question that we've seen a lot of the non-commercial long open interest liquidated in the last 3 or 4 trading sessions as speculative positions have been liquidated as the price has moved to the downside. Equally, I think the commercial short interest that's built up in that market will probably also be looking to cover with that downside move. And, if anything, we may well have seen an interim low of meaningful significance in the gold market in the last 24 hours. If we look at the move from 1530 up to 1800, we've seen approximately 50% of that move now corrected, and we've had a spike to the bottom with the gold price pushing well up off those 1635 lows overnight. So, if anything, that sort of tells me we may have seen the end of this current corrective sell-off. What was also interesting is that the gold shares didn't really follow the metal to the same extent. That also says to me that a meaningful medium-term bottom may have been found. And I still stick with our scenario that the gold price will get back to 2,000 next year. There's a significant backdrop that will support the sector. We've got central banks deploying quantitative easing. We've got a number of central banks now doing that, and of course the Chinese are accumulating aggressively gold on the open market. It's illegal for any gold producer in China to sell to anyone but the government, and I think this sets up an interesting dynamic, which I'm going to write more about in the new year. But I believe that the Chinese authorities are looking to reinstate convertibility into gold with respect to their currency. We also had an interesting week this week with respect to Japan. A major move in the Nikkei above 10,000 for the first time in a few years on the election last week of Shinzo Abe. I think that this stock market is going to go a lot higher, and perhaps along with China will be one of the best performing markets in the new year. I think we could see the Nikkei move well beyond 18, well, certainly well beyond 15 or 16,000 in the new year. The stock market is very, very cheap, and if the Bank of Japan is successful in bringing down the value of the yen, it's going to provide a major impetus to the export sector and indeed the economy. Secondly, the public are attracted to movement with respect to the stock market, and if we see the Nikkei move up aggressively, the public will start to re-engage. And let's not forget that Japan is a stock market which has been deserted by the public for the last decade. It's been one of the worst performing stock markets in the last 20 years, and as a result of that, the participation both at a foreign level and at the public level was at a record low. So I think that will begin to reverse, and we will see a lot of cash begin to re-enter the sidelines. At the moment, you can buy companies like Toyota for less than its book value, or Nomura, household corporate names for less than their book values. So it really is a value investor's dream. But I guess with respect to Japan, we were always going to need a circuit breaker, something to break the cycle and change sentiment. And perhaps Shinzo Abe and his easy monetary policies are going to do just that in 2013. And I might add that he may well be the Prime Minister that actually lasts more than a year, given that Japan's gone through 7 leaders in 7 years. So I think on that note, we're in for an interesting 2013. I think the markets are going to get off to a reasonably strong start in January, and looking for some form of resolution on the fiscal cliff to provide that impetus to the upside. I look forward to joining you again in the new year, and it will be the week of the 7th that I will resume these audios on the Friday. And so until then, I wish you all a very restful and merry Xmas break. Drive safely on the roads, and all the best to you and your families. And on that note, I will say goodbye and sign off for 2012. Bye for now.